The Fed's decision overnight, a non-decision perhaps, stand pat. Some say that perhaps it was the wrong decision given how strong the U.S. economy is right now. Your thoughts on that?
Yeah, so I do think that more rate hikes are warranted, and the Fed's likely going to move again in December. December is the more likely timing because the market had not been prepared, and the Fed for the first time will have 2026 like the ECB in their forecast. So it all will depend on how inflation turns out in 2026 in the forecast. I think it's going to be closer to 2%, but not at 2%. So I think another rate hike is likely in the books. Same for Europe. And then they're going to go into pause because it's election year. They don't want to rock the boat. But fiscal policy is still very expansionary. So the mix of policies in the U.S. still is very, very, very favorable for the economy. And they're likely going to maintain that higher rate for some time now.
A very complicated time, it seems, for central banks, because just as they thought that they're done tightening, we've seen Asian central banks tightening yet again, including the likes of Indonesia. How does it look for the ECB?
Well, so from an ECB vantage point, they have the European inflation issue to deal with. Inflation is relatively global. That's why we've seen the most pronounced, the most synchronized, and the steepest rate hike cycle in post-war history. They all moved at the same time. Emerging markets like Brazil have even front-loaded these rate hikes in the U.S. So emerging markets have done, on average, much better than any previous rate hike cycle. They're more stable. They didn't see the capital outflows to the U.S., so there's no problem about capital flow reversals. There are some sudden stop issues still because money stopped flowing to some emerging markets. But from an ECB vantage point, which you asked about, the ECB is likely going to go on pause and basically wait for what is happening. There will be a massive repricing that is still ahead of bonds versus equity. I think the equity markets that really were favored by the tailwinds of a lot of liquidity are going to see the withdrawal of liquidity by central banks as a structural headwind. So a further correction in the equity market, in my view, is likely in Europe as in the US. And then bonds are getting more attractive. Actually, the last rate hike is usually the point where markets start locking in longer maturities. That's likely to start big time at the end of this year. So you're going to see selling pressure on the short durations. You're going to see more moving into longer durations. But you also at the same time see a much bigger issuance of the Federal Reserve and in the Treasury in particular at the long end, which is why they just last night also tweaked their announcement about the issuing calendar, de-emphasizing somewhat the issuing at the long end and moving to shorter maturities. So the interplay between fiscal and monetary policy, both in the US and in Europe, is going to be very important for the next 12 to 24 months. I don't have a recession as my main scenario, but it's a risk, and it's an increasing risk. But the real issue is when will the U.S. fiscal deficit and debt dynamics be broken? And I don't think that will happen before the election.
We talk about risk. Are traders, the markets, underappreciating the potential risks from geopolitics like the war between Israel and Hamas right now?
Oh, absolutely. And I do think that that is something that will continue to be in the headlines. It's likely to escalate further from here. So it's very hard for markets to price geopolitical risks. That's not what markets can do. Markets can price credit risk, interest rate risk. And we've seen some failure in some key banks to even price interest rate risk in the banking book, which is a sort of, bread and butter business of banks. So I do think the market at the moment is facing a very difficult moment because after almost 2 decades of ultra-loose monetary policy is now normalizing. And that new normal, with rates not being at zero, but somewhere sort of, in the mid-single digit, is a new normal the market hasn't really fully priced in. And so what we're seeing is people that have been in the market for the last 10, 15 years haven't seen this rate hike and this rate environment, and they're getting used to it. And getting used to it means they're adjusting their trades. And that's something that we will see play out. Geopolitical risk is a risk that comes on top of all of the risks the markets already have. And I think for the next couple of months, it's just going to increase uncertainty. So not the choices themselves, but the conviction around these choices is going to go down. Uncertainty means you probably do less than you would do if you were more certain. So the repricing is going to be more cautious than it would be without this geopolitical risk. And that means it will drag out longer.
That strong dollar environment, though, I mean, for the longest time, people were expecting the dollar to weaken, but not the case. It is creating some havoc, especially when it comes to Asian economies. Your take on it, and how sustainable is the dollar at the current level?
So basically, the US dollar has been largely following over the last 12 months the interest rate differential relative to the euro, for example. So the dollar is trading in line with how rates have moved. If you look at the new rate normal that we're now seeing, the US rates are going to be structurally above the European rates, and the European rates are above the rates in Switzerland, where I used to live the last 10 years. And that means that structurally, the euro is going to be weaker than the dollar. But then on the other side of that is the interest rate differential is favoring the dollar. But the debt dynamics in the US and the very high deficit at full employment is actually a counterfactor, and the downgrade of the US plays into that. So I think the dollar is pretty much hanging in there in a limbo. Real dollar movements will not happen before we've seen the election outcome in the United States. There will be some adjustment. Structurally, I see the dollar weaker as well over the next 12 months, but not big time. I think that would require big news from fiscal policy in the US. And as I said, we're not likely seeing that over the next 12 months.
Axel, I'll be remiss not to talk to you about UBS and the fallout from Credit Suisse. I want to take you back to that infamous rescue weekend where the Swiss government did get in touch with the likes of Amoti. I'm just wondering whether you were approached as well at that time.
Well, look, I have a very simple policy: never look back, never go back. And so when I left UBS, we were very well prepared as a bank for problems at our biggest competitor in the home market. The board has been looking at that. The worst thing that can happen to a bank is that its major competitor in the home market becomes destabilized and you can't stabilize the situation, or a foreign competitor comes into the market and is then a formidable competitor in your own backyard. So UBS was well prepared, and I can tell you, until the day I left, that was a scenario we always had on our radar screen.
The integration between UBS and Credit Suisse, of course, makes it a gigantic bank. Is it now well positioned to compete with the banks on Wall Street?
Well, I think it's pretty clear that UBS is now a bigger and a much more formidable player in the European and in the global markets. As I said, we always had that scenario as a scenario that would be worthwhile pursuing. Again, I'm not going to talk about details because I haven't been around. I am occasionally called on by the Swiss government when they have an offsite, and so I'm in regular contact with the authorities there. But that's a confidential discussion that we have, and I wouldn't take that public. But I do think that UBS is now catapulted into a league of banks where, even more than in the past, it can actually be a good rival for the major US banks, both in the European and Asian markets in particular, but also on the US home market. And I think that is something that the bank has been preparing for many years. It's like with sports. You're never good if you don't prepare. And so it was well prepared. And I have all the confidence in the current leadership that they will excel and make this opportunity really a great future for the bank.